All right, beautiful. I'm gonna give you the speaker view. Spotlight. Okay. Perfect. So for guys, thanks again for joining us on the virtual meetup. We have a combination of in-person and virtual to kind of bringing guest speakers and experts like Darin. For those who don't remember, we did a podcast a couple months ago or maybe a month or two ago where we kind of highlighted his story of getting into the syndication business. It was it had a lot of downloads, a lot of interaction. I had a lot of conversations about that to other investors. Because the big thing is that we're starting to learn in our group the power of syndications, how to kind of get it going, forming partnerships and like that. And you were able to, coming from another job, to transition into this business, and you had, a really good story. So if you don't mind, just pretty quickly for those who didn't get a chance to listen to it, maybe just give us a quick bio or a rundown of your story, and then maybe we can get, go into a little bit of the stuff that you're working on currently.
Absolutely. Dwaine, thanks for having me on the podcast a month or two ago, and appreciate you having me back tonight. So yeah, just a little background on myself. I'm actually an East Coast guy also. Originally, I'm from Brookfield, Connecticut. That's where I grew up. And I kind of transitioned through a number of different career paths. I started out as a accounting major at University of Rhode Island, graduated there, went to work for Price Waterhouse, got my CPA. From there, I went to work for PepsiCo out of Purchase, New York, and was in their domestic audit group for a year and their international audit group for a year. After about 4 years in accounting, I wanted to get into sales. So I transitioned into software sales, and I was selling larger ERP systems to Fortune 1000 companies. Did that for a while, did the .com thing for a little bit, and then I went to work for a top 20 worldwide bank at the time. I don't know where they are now. This is dating back to like 2002 to 2006 time frame, working for ABN AMRO. They're a Dutch bank, and I was on their mortgage capital markets trading desk. And so I was basically responsible for trading the loans that the bank was originating. The bank was a top 5 jumbo residential originator, and we also purchased a bank out of Chicago, LaSalle Commercial Bank, which was a large multifamily originator. So we were selling both the residential jumbo loans, and we were also selling larger portfolios of multifamily loans. So from that experience, I really got to understand the multifamily asset class. When the market turned, I left the bank. I started my own company in 2007, trading loan portfolios between banks, focused on residential, multifamily, and commercial real estate loans. I still have that business. It's been going since, again, 2007. A couple of years ago, I started to have a little bit of extra free time with my business, and I decided I wanted to really get into real estate, but I didn't want to do fix and flip homes. I didn't want to do residential. So I was trying to find a way to go bigger. And so I went searching, and I found a mentorship group that was purely focused on multifamily. And so I joined that group. The group was based in Dallas. It was the mentor is Brad Sumrock. And so I joined that group in December of 2017. And then in 2018, I went to work. I invested in 7 deals with other people where they were the lead sponsor, and I was investing passively with them. One of those deals, I was a key principal, so I signed on the loan. And then in December of 2018, I closed on my first deal where I was actually the lead sponsor. I partnered with another guy who had experience that I met from the group. And that was a 76-unit townhome community. And we raised about $2.5 million from 44 limited partners. So through that experience, it really really got me excited to get the message out to other people that, you have an option. You have an option not to just invest in the stock market, that these private placement deals are actually available to other people. And it's not just a finite set of people that, have access to this. So I want to get the message out. So appreciate Dwaine having me on tonight.
Absolutely. It was, yeah, it was really good, when we went through the podcast and kind of detail it. But yeah, the thing for this meetup, because what we've been doing to educate our groups, we've been getting a lot of investors coming in, and they're starting to learn more about, the passive investing syndication side. So the best thing to learn, of course, is if we look at deals, look at numbers. We have going to have some people talking about different marketplaces, and just trying to cram in as much education as possible, get people comfortable with the concept, and then if it's something that they want to do, they're able to kind of go in there and feel a lot more comfortable. So you're out in the
Sure.
Texas market. Can you kind of talk about people that were here in Connecticut, maybe just like a high level view of the marketplace? You're specifically in Dallas. I know because there's so many different submarkets. Can you talk about maybe just how the situation is out there and how the market looks?
Sure. So, when I look at, so I'm originally from the East Coast. I spent 14 years in South Florida, and I've been in the North Dallas market now for 10 years. And what I would say is, from my experience in multiple businesses and having customers and, all over the country, is that when you look at the major metropolitan markets, the East Coast, both coastal markets, East Coast and West Coast, tend to be, very highly populated. And real estate tends to be very expensive. So because of that, when you look at investment properties like multifamily, a lot of times the cap rates are just very low. So, if I look at California has very low cap rates. They may trade at a four cap rate, where here in the Dallas market, things are trading more like 5.5 to 6.5, depending on the asset. Some of the better assets, maybe a 5 cap. But one of the things that when I moved here, my residential house was probably, I bought a house on an acre and a half. It was a custom home. And if I took that same property and put it in South Florida where I was living, it probably would have been double the price.
Mm-hmm. Yeah.
So Dallas, over the last 3 or 4 years, home prices have gone up, and multifamily properties have gone up tremendously in value. Having said that, when I look at comparing the Dallas market or the Texas market in general to other major metropolitan markets, I still think it's extremely attractive from a cost perspective, from a value perspective, from a cost of living perspective. So people that, rental rates here are, if you're just going to generalize, $1,000 to $1,100 a month, where the coastal markets are going to be significantly higher than that. And that affords us the ability to improve properties and still have room to narrow that gap. So there are a number of people that have been in this multifamily space in the Dallas market for years, and that I've met that are nervous for the Dallas market. That from their experience, they were buying at $30,000 or $40,000 per door, and when I bought our property at the end of 2018, we bought at $80,000 a door, and people thought that was high. And here we are, a year and a half, 2 years later. Well, no, we're about a year later, and things are trading at $90,000 to $100,000 a door.
Wow.
So that when you do a comparison to somebody that was buying at $30,000, $40,000 a door, it makes it difficult for them to fathom still having value. But when you look at the cash flow, rents have gone up, enough to support those higher per door prices. So what's happening is in the Dallas market, in the Texas market in general, people are moving from California, from Chicago, from the East Coast, and moving into the state. So that's providing a lot of competition for these BC properties because they're not building any more BC properties. And what I would define as BC would be construction in the 1960s, 70s, and 80s. So those properties, they're not building any more properties like that. All the new construction is brand new A properties. So they're really geared towards people making 70 to 100,000 a year, where the properties that we're purchasing and rehabbing are BC. It's more workforce housing. So people making 35 to 60,000 a year. Another thing that's important about the Texas market compared to, say, California is we want to invest in landlord-friendly states. So in California, if you own a property and one of your tenants isn't paying, it can sometimes take 6 months to evict that tenant because the state regulations and laws are very supportive to the tenant versus the landlord. Where in Texas, is a very landlord-friendly state. And so if you have a tenant who's not paying, you can get through the eviction process in 3 to 4 weeks. That is very important when you're looking at cash flow on an investment. So hopefully that provides you a little bit of insight. Anything else did you want me to touch on there?
Yeah, that was perfect. Because I have this conversation a lot with a lot of local investors here in Connecticut, highly regulated, high taxed, coastal state and stuff. So and we can look at it from the, I forget the website that we talked about last time where we can show like the move outs in the state, and it's a significant exodus out of Connecticut. I mean, maybe some one-off deals, be good, but as far as kind of like, some larger assets that you're looking for good cash flow, good returns, Texas is definitely a key state there.
Yeah, so I'm in Dallas is one of the primary apartment states that's attracting a ton of attention. But we're not the only good market in the country. So you want to look at landlord friendly, and then you want to look at population growth and income growth. So if you're talking about Connecticut, people moving out, that's not a great characteristic for buying investment property for multifamily homes. But Texas is very strong. Arizona, so Phoenix is doing fantastic. Jacksonville, the Carolinas, just some other states that have strong demographics.
Perfect. For the deal that you purchased, so that's 76. So that's in Dallas. Can you tell us? I'm sorry. Go ahead.
Yeah, it's actually, so Dallas, you always hear Dallas Fort Worth. Fort Worth is about 45 minutes away from Dallas, and you kind of group the whole metroplex together. The deal that we bought was about 15-20 minutes south of Fort Worth.
So can you tell us, how did you find this deal? Was it through the partners, or was it kind of traditionally through brokers?
So it was actually an on-market deal through a broker with Marcus and Millichap. Okay,
beautiful. And then was that also, because we mentioned pre-call that it's right now it's very highly competitive. Was that also a bid process as well?
It was. It was a highly contested deal. It was a lot of offers, and we made it to best and final, and we came out on top. A few things helped where I developed a relationship with the broker on a deal prior that I did not win. I had one or two parties that overbid me on a prior deal. I was bidding on a deal in South Dallas with the same broker, and then he pointed me to this other transaction. So that relationship helped, but also I think that I went down there and I looked at a number of different comps, comparable properties that I was trying to bring our pro forma to. And I think that because I excluded certain comps that maybe other people were including, it gave me the ability to develop a pro forma that allowed me to pay a higher price, but still get the returns.
Nice. Okay, let me share the screen because we just went over the market, and it's all right if we start from there, and then I think it goes to the business plan.
Yeah.
Okay, share. Okay, can everyone see that screen? You can see that, Darin?
Yes.
Okay, beautiful. Okay, so if I click back a little bit, we already went over this kind of the marketplace. Darin's business plan too. This is, I'm assuming, for prospective investors or something like that.
Correct. This was, we got the deal under contract, and then after you get the deal under contract, you need to raise the money. So this was a presentation to present to prospective investors, and one of the important criteria, as I just mentioned, was population growth. So people moving into the state, that provides more and more people that can fill these units. And what happens when you take a property that you're gonna put rehab dollars into and make the property nicer and then raise rents, you have some tenants that are living there that are happy and they're willing to pay the higher rent, and then you have some tenants that would rather live in as cheap as possible, and they don't care if it's run down. So they end up leaving the property, they go to another property, and then we find new tenants to come in at the higher rents. But what makes it difficult if you're not in a state that has a lot of new population growth is if one of those tenants leaves. So let's talk about Connecticut or California or Chicago, where somebody leaves and you don't have influx of people, it may make it more difficult to find the tenant to fill that. And I had brokers, when I was looking for my first deal, I had brokers that were continually trying to get me to go out to some of the tertiary markets, maybe like two hours outside of Dallas. And the cash flow is attractive on those deals, and there's not as much competition on those deals. The downside is that, again, when a tenant leaves, it makes it that much harder to find somebody to replace them because there's not a lot of population growth in those tertiary markets.
Yeah, it's a lot of stuff that goes into the decision to for the purchase. For this particular deal, did you have a time limit as far as 3 to 5 years as far as for your exit on your business plan?
So our business plan, I'm part of a mentorship group, and we all use the same underwriting. And we set it up on a 5-year business plan, and we kind of set the expectation of a 3 to 5 year hold. If we buy and we're able to execute on the business plan and increase the NOI in 1.5 to 2 years, we'll sell at after 2 years. If we get to year 4 and all of a sudden we go into a recession, we might have to wait till year 6 or 7 to sell, when we come out. But just in general, we're kind of setting a 5-year business plan and, kind of setting expectations of 3 to 5 year hold.
And then are you running like a stress test scenario? You just mentioned, like, if in case the market changes, then we'll have like a different scenario. If either you hold it longer or you have an exit sale price that might be different that's reflective in the underwriting numbers?
So we would typically, we would look to hold it longer and look for a better time to sell. But what we do look at is, okay, based on if we do go into a recession, one of the first things that, we could do as a safety measure is either, reduce the distributions or hold off on distributions until we ride that wave out. So that's like an extra cushion. Now the lenders require us to be at a 125 debt service coverage ratio at the time of purchase. And then our business plan is to improve that. So, going into it, we already have that 25% cash flow cushion. Any improvement in the NOI is going to provide, just that much more cushion in a downturn.
For this property, did you have a specific 1% as far as kind of contingencies or stuff like the renovation, and also any reserves as far as kind of like capital reserves that the bank required, and what number that was?
Yeah, so the bank required $250 per unit per year for reserves, and we did a Freddie small balance non-recourse loan, 10-year fixed, and I believe our rate was 491. And we did what's called a step down prepay. So first 2 years, we would pay a 5% prepayment penalty. The next 2 years, a 4% prepayment penalty, and 3%, 2%, 1%, versus what's called yield maintenance. And yield maintenance can be extremely costly. So if you get 2 years into a 10-year fixed rate loan, you want to sell your property. There are owners that don't realize that what that yield maintenance prepayment penalty is going to be like. Sometimes it can run over $1 million.
Wow.
So, and with Fannie Mae, those loans typically only allow for yield maintenance, and most people don't either don't have an option for a step down, or it's too costly to choose that option. But the answer to your question was $250 per unit.
What was the occupancy rate when you guys first purchased? Is that on any of this page, or?
I don't know if it's on that. So in order to get an agency loan, either with Freddie Mac or Fannie Mae, which is a type of financing that we ideally want because it's non-recourse. If we were to go with bank financing, we could potentially get higher leverage, but two things typically happen. One is, instead of having a 10-year loan or a 10-year 10 or 12-year fixed rate loan, you might have a 3 to 5 year fixed rate loan, and then it's a balloon, or maybe it's a 3-year with 2 1-year extensions. But those deals, I'm not going to say always, but many times those bank loans are recourse. So what that means is you as the sponsor, you're signing on the loan. If something was to go bad, the bank could not, could go after and take over the property, but they could also come after all of your assets. Where we're going, us taking a non-recourse loan with Freddie Mac or Fannie Mae, if something was to go really awry and cash flow drops so significantly that we couldn't keep up with the mortgage payments, the agency, Freddie Mac, could come and take the property from us, and everybody would lose all their equity, which we don't want that to happen. But they could not come after me personally, my home and all my other investments. So that's important when you're taking on this loan was a $4.3 million loan. So, but another thing to note, another safety feature in doing these agency deals is, even during the downturn, of 2012, 2008 to 2012. The agencies, Freddie and Fannie Mae, who are the largest lender for multifamily property, their delinquency rate was like 1.25% or 1.5%
Mm.
at the height of the downturn. And that was the greatest recession we've had since the Great Depression. Their delinquency rate typically is less than 1%. So the fact they have so much data, on all their loans across the country, that when they, we'll do our underwriting, and I know you have, some pages here that we can talk about, but then when it goes to Freddie, they do their own underwriting, and they're comparing, the cash flow scenario to all the data that they have on all their multifamily properties, and they don't want to do a deal that's going to go bad. So they're very careful on what deals they approve. So, getting approved by Freddie and Fannie, that in itself, going through that process, is another indicator that, these guys have a ton of data and they're seeing the value in this deal.
Yeah, that's one thing. I talked to another investor and he said the exact same thing. And it adds another level of comfort that it's like another eye that's looking over it to say, my underwriting's good, the purchase price, everything, the business plan, everything looks good. So that's very comforting to hear. I'm sorry, I don't know if you may have said it, and I do apologize, but before I ask that question, do anybody in the group have any questions so far that we can ask Darin? It's open forum, so anything you want, and we'll just kind of go through as much detail as possible, but just hit your on mute button and ask your question if you have anything, or if you want to just put in the chat box and I can ask it for you. Okay, nothing so far. Okay, everyone is satisfied with the information so far. That's good. We're not boring anybody. Perfect. So, okay, 76 units, 1983 construction, 14 buildings. So did you had said there was some occupancy, and then like what was the business plan as far as the amount of units that you were going to renovate? Whether it was it below market, and kind of what's some details about that?
Right. So this goes to the agency loans also. So in order to get a Fannie Mae or Freddie Mac multifamily agency loan, they require that the property is stabilized. So they would define stabilized as 90% occupancy or greater in the last 90 days. Okay, so any of the deals that we look for, we're looking for deals that are 90% plus occupied, that have some kind of value component. And that value component could be a lot of different things. For this deal, it was an early 1980s property, but the exterior hadn't been renovated. The interiors were the original interiors. So we had the ability to renovate the interiors, make them look nicer, and then also clean up the exterior as well. But here's one thing that I learned through, and multiple people warned me about this, have taken on my first property. They all said, Darin, once your deal closes, your occupancy is going to drop. And I was like, I don't know if that's going to happen on this property. And sure enough, it did. So,
wow.
What happens is the seller of all these properties, they know that you're getting an agency loan and they know the requirements. So because they know the requirements, they know that, okay, between contract and closing is typically 60 to 90 days. Okay. If the owner drops below 90% occupancy, then you as the buyer is going to have a difficulty with getting that approved. So they just at times will just fill, that top 5 or 10% with some people that maybe didn't meet all the, the criteria that they typically would look at for a new tenant. So when many times, it's not always the case, but many times when you first close on the property, the first few months, you as the new management company, as the new owner, are going to find, slow paying customers or non-paying customers that you have to kind of, weed out and get some, better tenants in there. It doesn't always happen, but people warned me, and it did happen for us.
Mm. Did you also switch over the property manager, or did you keep the existing one on? And then we'll kind of go into your process of inspections,
Sure.
all that stuff.
So this was a little bit of a different scenario. Typically there's a property management company on the property. And so we focus on 60 units or greater in terms of size. And the reason for that is that typically 60 units or greater can afford a full-time leasing person on site and a full-time maintenance person. If you get to like a 30 unit, you can't afford all that payroll. So you have to have, part-time people, part-time help. So we try to focus on 60 units or greater. Your question was?
Oh yeah, I was just going to talk about like kind of your whole process of the
property management company you were asking about. So typically there'll be a property management company on site. And then when you buy the property, you decide, do I want to keep the same property management company, or do I want to, bring another property management company to take over? In this scenario, it was a little different because the property was owned by a California investor who self-managed. What I mean by that is they did not have a professional property management company that managed the property. They simply hired one leasing person in Texas to lease up the units, and then they would just interact with the owner in California. And so when Marcus and Millichap got the listing for this project, they convinced the owner to bring on a property management company during the selling phase, and to renovate a few of the units to prove out what they can do, what they can get on a higher rent if you did do an upgrade. So that's what they did. So they brought on Wayner Multifamily like a month or two before they put it up on the market. So when I looked at the property, they did have a property management company there, and they had renovated, a couple of units, and were getting higher rents for those units. And then when we put together the business plan, we decided to keep Wayner Multifamily on the property.
So I see here that cost segregation was part of the plan as well. For those who are not familiar, can you kind of explain just like what it is and kind of
Sure.
The helpfulness of that?
So cost segregation has been part of the tax law for years and years and years and years. And what it allows you to do is you hire a third-party company, and if you just bought the property, and multifamily is considered residential, and so you could depreciate. We purchased this for just over $6 million. We could depreciate it straight line over 27.5 years. Okay. But if you were to hire a company to do cost segregation, what they'll do is they will look at, okay, what's the value of the appliances? What's the value of the flooring? What's the value of the electrical? What's the value of, all different components of the plumbing of the property? And then after they break out those different components, those components can be depreciated over a shorter life period. So, maybe, I don't know all the specifics, but maybe appliances are depreciated over 5 years or 7 years, and electrical is over 10. Well, if you were to depreciate it over a shorter time period, then your year one depreciation expense is going to be higher, which is allocated to each of the investors in the deal. Okay.
Mm-hmm.
The big kind of huge factor that took place during the Trump tax law of 2017 is that all those components that are broken out during the cost segregation, 7-year, 10-year, 15-year life, you can now depreciate all of those in year 1 of acquisition based on taking what's called bonus depreciation. So now, we purchased this property December 21st. We only owned the property for 10, 11 days in 2018, but we were able to depreciate approximately $2 million out of the $6 million.
Wow.
So that $2 million of depreciation expense gets allocated based on the ownership percentage of all the investors. And then, depending on each individual's tax consequence, you may be able to take full advantage of that, or you may not. So there are criteria where you can take that loss, and if you're considered a full-time real estate professional, you can take all of that loss and apply it to, other income from other businesses or other investments. If you're not considered a full-time real estate professional, then you can use that depreciation expense to offset other passive income. So if you have other passive income, so for example, I have an individual that I'm friends with. He invested $100,000 into the deal. On his K1, he had a $65,000 loss. Okay. And so I asked him, we went out to dinner, I asked him, hey, were you able to take advantage of that loss? And he said, absolutely. He said, I thought I was going to get, this amount back in taxes. And I actually got like another 20,000 because
Wow.
he was able to use that loss against other passive income that he would have had to pay taxes on. So there's significant tax advantages if you can take advantage of them.
Of course. Gritton, you had a question? Gritton? Maybe he just typed it into the chat box. Are you there? Okay, man. I'm just having some. Hi, you had a question?
If you could have one is fine for me.
Okay.
I'm not sure if you want it. It's okay. I'll put it in the fridge. I can able to know.
Okay, I apologize about that. Okay, so anybody else have any questions so far? Everything good? Okay, looks like we're good. Okay, perfect. I'm just what's your process of analyzing the units? So you walk with the property manager, you look at all the units, kind of go through a checklist of things that you need to be repaired. I mean, overall, you're going to say, I'm going to upgrade all the units, because they're, probably older and stuff. But what was your process of, kind of going through that to kind of make your assessment? Of course, that would affect your offer price and all that stuff, and things for your renovation budget.
Yeah, so it's not a perfect science. So the property goes on the market, okay, and at that point, the listing agent will have property tours. So go on the property tour, and typically what they do is they just walk the property with you. You're just getting a feel for the property, the feel for the area. You're looking at the cars in the parking lot, and then they're going to take you to, a few of the units. Usually, if available, they will take you to an upgraded unit, and they'll also take you to an older unit, so you can see, kind of the before and after.
Mm-hmm.
From there, you're kind of ballparking a little bit, you know, what you think it's going to take to upgrade the property. I would say in general, I see in our group anywhere from 3,000 to 6,500 a door. So, with talking to a lot of other sponsors and then looking at other deals, and when I invested passively in 7 other deals and reviewing their business plans. So after you do it a number of times, you kind of get a feel. If it's a really, really rundown property, then you're going to want to lean higher on the cost per door. If it, it's not that, it's pretty well maintained, but it needs a pick me up, then you might be a little bit lower. So it's not a perfect science. At this point, when you're putting in an offer, you've maybe looked at 2 or 3 of the units. You haven't gone into every single unit. You don't get the ability to go into every single unit until after you've gone into contract. And once you've gone into contract, you've put most deals, pretty much all the deals in Dallas, but most multifamily deals across the country today have significant hard money day one. So, you're putting up 100, 150,000 or more, depending on the size of the deal, it could be significantly more. On the larger deals, people are putting up 300, 400, 500,000, a day after signing the contract. And at that point, you go into the due diligence period, and we bring on our property management company, and they do 2 things. They've got 2 people that will do a lease audit. So they're gonna take the rent roll and they're gonna compare that to all the leases. And then they also have a team of 3 or 4 people that are gonna walk each unit, and they're gonna they typically have like an iPad that they go through a checklist of what items they think that are going to need to be repaired or replaced. And then we also hire a third-party inspection company, and they bring their own team also, and they go through the same process. So we've got kind of 2 teams, plus us as the sponsors going into each unit, and then they're both going to provide me with a report back, give me a feedback as to what they think it's going to cost to make everything right in the interiors. Now, people are living in the units, so although we've had 2 teams walk through and identify a bunch of things that may need to be replaced or fixed, we're most likely not going to do all that work until the tenant decides to leave the property, and then we go in and we renovate that entire unit, if that makes sense.
Yeah, absolutely. How long did that process take for you? All the inspections and everything?
1 day. So 76 units in 1 day, and so I had two teams going into each of the units, and then the head of the inspection company that we hired, and they're a well-known multifamily inspection company in the Dallas area. What the value that he brings is he ends up bringing a master roofer, he brings a master plumber, a electrician, a foundations guy, a termite guy, and so he brings all those people, he coordinates that, and then they go and do their own inspections on what they're, so the electrician is looking at all the electrical work. The plumbing guy, he's got this machine that he scopes like all the sewage lines, and then they come back to the head guy from the inspection team and give them his findings. He puts together a summary report and gives me a feel for the quality of the property and where he thinks I'm going to need to spend money. So when I did the property tour by myself, and then I put the offer in, I may be thinking $4,000 a unit. And I might be thinking, half on the interior and half on the exterior. And then I hear back from the inspection guy, and he may tell me, you know what, you got some bigger issues here. You're going to have to spend some more money. I may have to sway a little bit more money from the interiors over the exterior, or vice versa. He says, you know what, I thought we were going to have problems here, and you really don't. And then I could reallocate money over to the interior. So at the time of offer, it's not a perfect science. There are sponsors who have 2, 3, 4, 5 deals under their belt, and they've done a lot of work with contractors, and they've done a lot of business with property management companies. They will at times bring out those people prior to putting in an offer, and just hey, I want some extra eyes on this before I put in an offer. So, but typically a first timer is not going to get the property management company running all over town with you until you've done some business with them.
Yeah, of course, that definitely makes sense there. Perfect. Anybody have any questions so far? We kind of went through a lot of stuff.
So let me just ask you this. I don't know the people that are on the line, would you say that they're interested in investing passively in types of deals like this, or is everybody looking to do their first syndication deal? Is it a mix? And I asked that just so I can gear some commentary to appropriately.
Yeah, I would say it's a mix, but probably more so people getting into syndications and then eventually maybe doing exactly what you do on the sponsor side.
Okay.
Yeah, so like I said, we got a couple of people that has some interest in getting into some deals, and some people that want to do kind of their own process. So maybe just kind of a mix, but whatever. I mean, all of this is valuable content that we're getting. So
I think that I don't know how many people have looked at any syndication deals or haven't looked at it all, but like one of the first questions I would have if I'm on the line and I'm maybe considering doing my first passive investment is, all right, this is all well and good, but like, what are the returns? What are the expected returns to me, as the passive, and what are the minimum investments, that was important to me when I first started looking at multifamily deals. And most deals, the minimum investment is $50,000. Some smaller deals I've seen $25,000 or $35,000 minimum investment, and some of the larger deals I've seen $75,000 or $100,000 minimum investment. So that's typically the minimum. The second question is, okay, well, what are the forecasted returns? Most multifamily deals that I've seen typically have a average annual cash on cash return of somewhere between 7% and 8%, and a total return on the investment of 70 to 80%. So the best way for me to describe that is, say somebody invests $100,000 and it's a 5-year business plan, and we said, let's just assume that we sell at the end of the 5 years, and let's assume that we did 8% distributions every year. So if somebody invests $100,000, they receive $8,000 in distributions each year for 5 years. So they've received $40,000 in distributions. At the end of the 5 years, we've forecasted that we've increased the value of the property such that when we sell, the investor would have a capital gain of $40,000 and then get their $100,000 of original principal back. So that's where the 80% return comes from. So they invested $100,000, they received $40,000 distributions and a $40,000 capital gain at the back end.
All right, nice. Any other detailed questions on top of that? Brother Milton, Fred?
Hello?
Yes.
Is this only about syndicated deals, or what about if you wanted to purchase, say, your own, say, 17 to 20 unit property? Like, can I ask questions about that?
Yeah, sure. I mean, a lot of the principles are the same. I mean, we're dealing with like larger numbers, but the whole process of vetting a deal, looking at the market is all still the same. Do you have any specific questions on that? But yeah, I mean, yeah, definitely all applies. But yeah, we're looking at like larger stuff and kind of the detailed numbers,
Well,
but we definitely would love to help.
so my situation is I'm looking at a property out of state, and I'm listening to Darin describe, I guess, his sort of due diligence process. But my property is, a lot smaller, say 17 to 20 units. Um, I don't know if you would have any advice for how do you go about doing the due diligence, because I'm picturing the tenants, like would I really get the tenants to cooperate and be able to see all of the interior of all of the units? And would I really be able to hire like all those people he was talking about to say, this is how much you're going to need to spend on each unit? I just feel like in my mind, it seems like it's going to be a lot more complicated.
Right. So I can't speak for buying a 17 unit deal because I haven't done that, and I can't speak for buying out of state either. But one, yes, you can get access to all of the units. I don't care if it's a duplex, fourplex, 12plex, 20plex, or 300 units. But you typically won't get access until after you're in contract on the property. The seller most likely will not let you go into the unit. So the owner of the property has the right to inspect any of the units at any time. Typically, the leases will say, we'll provide you with 24-hour notice that we want to come inspect. So the owner always has the right to inspect. So you would have the ability to do that. In terms of the costs, I don't know how. Obviously, the larger deals you do, the cost per unit for doing that evaluation is going to be substantially less. But maybe you hire a similar type company that has that expertise, but he doesn't bring on all the trades. He gets on the roof and looks at the roof, and maybe he inspects the exterior of the buildings to look for any visible foundation damage. And if there, maybe he just looks at the quality of the AC units on the exterior. But I would not want to buy a property from out of state and not have somebody that has expertise in that area take a look.
Yes.
Because you don't want to buy, and that was one of my fears actually getting into this space was I'm not an engineer, and hey, I'm buying a 76 unit property or I'm looking at a 100 unit property. I don't want to purchase property that has, physical damage that I won't recognize, and I don't have any idea what to look for. But these companies, that's what they specialize in. So you're going to want somebody to take a look at it and at least tell you about the roof and the foundation, some of the, so that you don't buy something and all of a sudden you have a huge expense that you didn't budget for.
Mm-hmm. One other quick question. Let's say you do that investigation and you find the property is in worse condition than you thought. Are
Right.
you then allowed to change your price, or is it that you already agreed on the price or what?
Right. So it depends on the market, and it depends on what you agreed to in the contract. Okay. So theoretically, the way these multifamily and commercial real estate contracts should work, okay, is that you enter into contract and you have, say, a 2-week inspection period, due diligence period, 2 or 3 weeks. And then during those 2 or 3 weeks, you would hire the companies to come, look. If you find that there's issues that weren't brought to your attention, then you potentially go back and renegotiate or walk from the deal. Okay, that's in a normal market, that's the way it would work. But in today's market, and when I say today's market, it's been like this for the last, 3-4 years. These multifamily deals are so highly competitive that in order to win the deal, in order to have the seller pick you as the buyer, we as buyers have been required to put down what's called hard money day one. So if you put down 100,000 or 150,000, 200,000 day one, now on a 17-unit property, maybe you have to put down 25,000, I don't, somewhere between 1% and 2% of the purchase price. So, if you have that money hard, okay, what that means is you sign the contract, the next day you wire the money. If you decide to try to renegotiate and the seller says no, well, now your option is walk and lose that 100,000 or continue on with the deal and make it work.
That's tough.
Yeah, that's why I was saying the importance of getting someone in that local market that is very well versed and knowing, like I said, it could be foundation, roof, or I was talking to another investor whose specialty is in Arizona, and they're looking at other markets, and they won't touch anything until they work with another sponsor on a JV, because like in Arizona, it's always warm, and if you go somewhere in a colder place, it's a total different type of property. Like for me in Connecticut, going to Texas, I rather for my first deal work with another experienced sponsor that has boots on the ground that are able to navigate those waters. So because especially if you have money hard day one, you got to know what you're doing. If not, you're going to be in trouble.
Yes.
Right. And there's a lot of parts that are a little scary, and that's one of them. Is nobody wants to put money down and then just have it lost. So, but that's the reality of today's market. The reason why the seller does that is because they know that if somebody puts down 100 or 200,000, they're most likely not going to walk from that. Mm-hmm. So they want to pick a buyer who is committed to closing the deal. And if they have 15 people putting offers on the property and 3 or 4 are all around the same price, then they're gonna pick somebody that's putting a lot of money at risk.
Okay, thank you.
Great question. Thank you so much. Anybody else? All right. Well, we'll come in. So, okay. So we already talked about the purchase price, all that stuff, price per unit, everything is there. I had a couple questions that kind of passed me by. Okay, and then we talked about as far as like a passive investor, kind of like a typical return. Did your deal offer any preferred return, or it was a straight split, or?
We did not do a preferred return. We set expectations that the first distribution would be after 6 months and then quarterly thereafter. And this number on here is an average distribution over the 5 years. So the first year I think we had forecast like 5.91%, and we've been paying out as a 6% distribution. So just north of what we had projected for year one, and then in year two, we're projecting to increase that distribution from there.
Nice. Oh, Francisco, I'll get back to you written again. You had a question?
Yeah, can you hear me?
Yep.
I wanted to just know, how does it change, like if you run into a property, because right now I'm trying to target like BC value add properties, and I've been looking at stuff like in the Hartford and New Britain area because this is my backyard.
Okay.
And I noticed like a 60 unit that's definitely value add, but it's not listed right now. So how does the change between like a property that's actually being marketed by a broker opposed to something that is not listed at all? Like, how does the dynamic change, like initially, like when you're trying to go after a deal that's actually listed with a broker opposed to one that is not listed and is off market, but you might see where you may be able to make it?
Okay. So if I was to define like different levels, you've got deals that are on market with listing brokers. Then you have, let's say two or three different types of off-market deals. Okay. One is an off-market deal where, say I'm an owner and I have a good relationship with a broker, and I say, look, I don't really want to put this out to market to everybody. Can you go to, 3 or 4 guys that this property would be a good fit for? And this is kind of the pricing I'm looking for. Can you see if you can make something work? So the broker then calls, the 3 or 4 or 5, whatever, top guys and say, hey, I got an off-market deal, sends over the financials and underwrite it and try to negotiate a deal. Okay. That's a legit off-market deal.
Yeah.
I'm the seller and I'm looking to sell, and the broker is bringing it to, people that they know will close. Okay. So that's one type of off-market deal. Another type of off-market deal is the time waster off-market deal. Okay.
Yeah.
So that's a broker calls me and says, hey, Darin, I know you're looking for another deal. I've got this great off-market deal for you. Okay, tell me about it. I say, okay, let me send you the information. I think it's a good deal. The seller is looking for 10 million. I look at the deal. I underwrite the deal, spend time reviewing it. I look at it and I'm like, there's no way that this property is worth 10 million.
Yeah.
Based on the cash flow. Okay. So that scenario, what happened is the broker is dialing for dollars. Okay. Yeah. So their job is to just call owners of multifamily properties, and they get this owner on the phone and they say, hey, are you looking to sell? Well, I'm always looking to sell at the right price. Well, what's the right price? And the owner's like 10 million. Well, yeah. The owner knows that 10 million, his property is not worth 10 million. But yeah. He's like, look, if this broker can find us a buyer dumb enough to buy it for 10 million, I'll sell it. Okay. So the broker calls and wastes my time. Okay. But what he's trying to do is he's trying to develop a relationship with me. Okay. Now that deal doesn't work, but hey, what kind of deal would work? So maybe it's not one of the brokers that I bought from before, or I've worked with before. And now he's trying to get to know who I am, how I underwrite deals, what type of properties he should come back to me with. Okay.
Yeah.
Now he loses credibility with me because he wasted my time. It wasn't a realistic off-market deal. It was I'm going to try to invest time with Darin type of deal. Okay. Yeah. So that's the second off-market deal. The third type of off-market deal that you're asking about is, hey, there's no broker talking to this property at all. It's a 60-unit deal and an owner owns it. How do I go after that deal? So I don't know the full answer to that because I haven't done it. But what, you can one, look up the owner on, on the property tax records.
I
But
found
typically,
that I'm just trying to figure out how do you approach that. Like,
well, if I know who the owner is, do you have their phone number?
No, I can get it though. I just found out who the owner was today. It's actually an attorney who used to who passed away, and his wife or daughter inherited the property. So they've had it for like the last 3 years, but it's not being run too well. But I can get I don't have it currently. I can definitely get it.
So, if I had that opportunity, I would call them and say, "Hey, look, I'm a current owner. I'm also part of a multifamily mentorship group. Within the group, we've purchased over $500 million in the first half of 2019. I came across your property and I'm very interested and wanted to see if there was any, if you had any interest in selling. I can turn around a quick response, but want to get and then I would just listen to what he has to say and try to find a pain point.
A quick question before, and at that point, would you consider, going forward, would you just be communicating with the owner, or at some point in time, you as the buyer, would you bring a broker in, or it's not necessary?
It's not necessary. I wouldn't bring a broker in to, you're going to pay a
extra money,
2 to 3%, commission rate on that. And you also have to understand that brokers in multifamily and commercial deals, they represent the seller. Okay. And they're looking to do everything they can to maximize the sales price and get a buyer that's actually going to close. Okay. But they don't have any, it's not like residential, where residential, there's typically a listing agent, the selling broker. And then you as the buyer, you might be running around town looking at different homes with a buyer's broker. Right.
Yeah.
And the buyer's broker and the selling broker are going to split that 6% commission, 3% and 3%. That's not the way it works in multifamily. Like, they're going to have a 2.5% commission, and they're going to keep that. If you want to work with a buyer's broker, you're paying that, out of your own pocket. It's not going to come out of the listing broker's commission. So you getting a broker involved is just going to increase the cost.
Gotcha. So there's a chance, though, that after I approach this off-market owner, that they might want to bring a broker in, correct? To basically
correct. I mean,
complicated transaction.
Right. They could decide, hey, look, I've got this interested buyer, but I don't really know what the market can bear. Maybe I'm better off putting I'm with a broker and maximizing, the price. I don't know all the right answers on how to have that discussion with that owner, but there are books that talk about that. Like looking at, and it's similar to what people would do on single family, but you're trying to find a pain point, from the owner's perspective.
Yes.
And how can you solve that problem for him? So it might be, our property management company has been a headache and I just can't get a good one, or I bought the property, but now my mom is sick and she lives in Florida, and I want to relocate to Florida to be closer to my mom, and I really would like to offload this thing. Well, you hear that, that's, music to your ears, because now all of a sudden you're like, well, look, if we can agree on a price, I can, I'm ready to go. And so that's makes his life easy,
Yeah.
But, you're going to come across owners that are like, I have no intention of selling.
Yeah.
And then what's your next question that you ask them after that,
Yeah. Just move on. Yeah.
So.
Okay. Thank you very much.
Sure thing. But there are people, it's not my strategy. My strategy is to go after on-market deals and that first scenario off-market deal where it's a real one. Because the thing I don't like the competition in on-market deals.
Yes.
But I know the seller is committed to selling. Okay. A lot of off-market deals, whether it's in your scenario or, one of the other scenarios that I talked about, the seller at times, it could be wishy-washy, hey, yeah, I'm interested in selling. And then, they don't get the highest price that they want. And they're like, I think I'm just going to hold it for another year. Well, when you start analyzing these deals and start investing time, it's a lot of time and energy looking at these deals. And, you don't want to invest all that time if somebody's not committed to selling.
Yes, makes sense.
But there's other multifamily buyers that I've seen that, they that's their whole strategy is to send out a ton of mailers to owners. They know they're going to get, only a 0.5% or 1% response. But they're going to work with that owner and try to solve their pain point and get in at a lower price than if it was a marketed deal.
Gotcha.
All right, great. Thank you, Francisco. Appreciate that. All right. Yes, okay. Any other question?
Darin?
Yeah.
Hi, Darin. Yeah. Can I go back to a topic you talked about earlier? And I apologize, my microphone was on mute. I finally got it unmuted.
No worries,
you asked
sure.
what the intentions of some of the listeners were, and mine is similar to what yours is, to start off as a passive investor and then slowly work my way towards being a syndicator.
Okay.
So on that point, I got a couple questions. How did you find and then vet your first passive deals? And then how did you increasingly kick up your involvement in each one of these deals to actually get some hands-on experience?
Okay, good questions. So for me, and this goes to most of the people that reach out to me via Instagram or otherwise that are looking to do their first deal, they're like, hey, what's the first thing I should do? And I'm part of a multifamily mentorship group, and it provided a lot of value for me. But not everybody, has the capital to invest in that. So if you have the capital to invest in a multifamily mentorship group, I would advise doing that. If you don't, then you want to go to as many of the free multifamily meetup groups in your market and start developing relationships with sponsors. Okay. So sponsors, just find out who are all the syndicators in the room and go exchange business cards with them. Let them know that you're interested in doing some passive investments. And those syndicators are going to add you to their investor database so that the next time that they have a deal available, they're going to email a summary on the deal. Hey, I've got this 150 unit deal. It's in Hartford. It looks like this. The expected returns are this. Minimum investment is X. If you're interested, fill out this form, and then we're going to have a webinar in 2 weeks. Okay. Something like that. You want to get on as many of those investor distribution lists as possible. Even if for one, you want to invest passively. Okay. So you may want to invest in one of those deals. Two, you want to see the communication that each of those sponsors sends out so that you learn from that. Every sponsor has a different kind of a different style on their communication. So if you see one, you're like, oh, okay, that's how they do it. Well, once you see 5 or 10, then you start seeing the differences between them, and you say, okay, look, I want to take this and this from the first guy, but I really like what the second guy did here, And so then you start in your own mind developing what your strategy and your communication style will be. Okay. Same goes with looking at the webinars. You're going to see how did this syndicator present the deal? Okay. What were their high points, and you're going to say, well, maybe you think that this is more important than that. So I would want to cover that earlier in the presentation. Or I would want to show that differently. You come up with your own flavor to that, but you can't do that until you start seeing multiple deals. So you asked, how I vetted those sponsors was that I was part of this mentorship group, and I got to know them by going to a lot of different meetings. And then in addition to that, I also asked other people who have invested, of their experience. Hey, have you invested in any deals that such and such put together? How did it go? How are the deals performing? How are they communicating? And then you start hearing, accolades, on some sponsors, and then you kind of get the feeling that a few other sponsors maybe you want to shy away from. So it's kind of word of mouth from that perspective. Well, another question you had was, how did you get further involvement in each of the deals? So my experience was, I invested in 7 deals. In each deal, I kind of wanted something different. And one of which is a resume builder. Okay, so before you own your first property, you don't own any property, right? So what are you going to put on your real estate resume? You've got, your career resume, but the broker is going to ask you for a resume to submit with your offer so that they could present it to the seller. And so one way to start building your resume is to be a passive investor. It shows that you're committed to multifamily. Now, people talk I'm an owner in 1,000 units or 560 units. And the more units just sounds like you're a bigger player. The reality of it is you could do one deal, in a 500 unit deal, or one deal in a 50 unit deal, and invest the same amount of money. So I kind of think it's silly the way that people talk. But I was hearing it over and over and over again. So I was like, okay, well, I want to get in this space. So I'm going to invest in some deals that have, more units. So, I could put that on my resume. In terms of, as I got further down the path with passive investing, I started to ask, hey, I want to get involved, and can I go on some of the meetings? Can I get involved in, one deal I said, hey, you got a lot of rehab and I want to learn about the rehab process. Can I be a part of that? Yeah, no problem. The reality of it is that once you wire your money and you're a passive investor, the sponsors, they get busy, doing their own thing, and they're not going to go back and handhold all the passive investors and bring them all on all these meetings. So that did not come to fruition. I was a key principal on one deal, and again, I asked, hey, can I get involved? And they invited me to come on the lender came to the property to do a tour, and I was present for that. I learned a little bit, but the reality of it is, I think what you're going to learn from passive investing is you're going to learn what it feels like to invest passively. You're nervous the first time you do it. So remember that nervousness and think about how you overcame that and how you will talk to your passive investors when you get your first deal. Secondly, you're going to learn about all the paperwork you have to sign. So there's an LLC agreement, there's a subscription agreement, there's a private placement memorandum. The first time you invest passively, these are all new documents. So you get it. You're going to become aware of that. And then once you're in the deal closes. Each month, the sponsor is going to send you a update as to, how the deal is performing and any highlights that are going on at the property. So you're going to learn from that process. And okay, when I start communicating to my passive investors, am I going to provide more communication, less communication, do it differently, all those things.
Great, Darin. That's a fantastic answer. Thank you.
You're welcome.
Darin.
Yes.
Hello? Yeah, it's Milton here. I'm just wondering, like, how do you said it's very competitive. The market is very competitive right now. How do you win your deals? Is it just by outbidding the next guy, or is it?
It's a combination. Okay. So one is, it's a combination of, I'd say, three things. Top price, top hard money, and the most experienced buying group. Okay. So the deals in DFW, almost all the deals are going to have 10 to 15 offers. Okay. Then they're going to do what's called best and final. They're going to pick 4, 5, 6 people who are the higher bidders. They're going to say, hey, you've been selected for best and final. They'll give you 3, 4, 5 days. Say, okay, we're looking for your final price, next Tuesday by 5 o'clock. So basically, they're telling the top 5 or 6 guys, go sharpen your pencil one more time and come back with the best price. When that comes back, there's typically 3 guys that are within 100, 150,000 of each other. Okay. Then they're going to look at, okay, well, what's the hard money? What's the at money risk on day one? One buying group might be putting 150,000 down. Another one might be putting $250,000 down, and one might be putting 200 down. So the seller may say, hey, let's go with the 250,000. If he doesn't close, I just made $250,000. Or they may, maybe all the hard money is pretty close. It's somewhere between 100 and 150,000 for all 3. And then they say, well, the seller says, who should I go with? To the broker. And the broker is then a broker doesn't want to get egg on their face. Okay. So they want to pick the buying group that has the most experience, that has the highest probability of closing. Okay. So you, as a new time buyer, first time buyer, will almost never win if you're by yourself. Okay. So in today's market, as highly competitive as it is, in order to differentiate yourself as a buyer, first time buyer, if somebody was putting 250,000 hard, you would have to put like 500,000 or 600,000 hard to differentiate yourself. So that doesn't really happen. So the way to get around that is you partner with somebody who does have experience. Okay. So for me, I was a first time buyer. I knew I couldn't win the deal. It's too competitive. I couldn't win the deal by myself. So once I got to the point where I thought I had a good chance of winning the deal, I had a list of 4 or 5 people that I respected and thought I would work well together, that had experience, that had purchased, rehab, sold 100 unit plus deals. So I called my partner. He's actually out of Chicago. I met him in Dallas through this mentorship group. Showed him the deal. He said, yeah, I'm interested. We partnered together. Now the broker shows the seller, hey, look, it's Darin and Raj. They're the buying group. Between the two of them, they own over 6,000 units and, have 4 or 5 deals that they sponsored. They don't look at it like, okay, Darin, that it's like the collective group. So you really, I have not seen somebody win a deal as a lone one person newbie in today's market. You know, unless you want to way overpay, you know, or way over put hard money down. So to get your first deal, just partner with somebody who has experience, and you can find those people at meetup groups. So you know, go meet other syndicators at meetup groups. Set up a Starbucks meeting, you know, for the next week or a week after that, and then ask them, you know, hey, how could I add value? How could, you know, what type of deal would I have to bring to you, you know, for you to partner with me on a deal?
Great answer.
So also, how do you so you said once your money go hard, if you try to back away, you know, you would lose it. How do you prepare yourself so that will never happen? So that, you know, once, you know, you go into the deal, you know that, you know, I'm gonna buy this property, you know. So
yeah, so that's where it's hard. I mean, you try to do the best due diligence you can before putting in an offer, and you know, you somewhat rely on, you know, the broker's assurances that you know, there's no major mechanical problems. Now, the ideal is after you have a deal or two or three under your belt, now you have relationships with roofers. And on my deal, one of the things that I was a little worried about was, so there's 14 buildings, and I was told that the roofs had been replaced in the last 6 or 7 years. But there were 2 buildings in the back that the roofs looked really wavy, and they looked older than the other 12 buildings. And I mean, they were, from the ground, they were visibly wavy. And I'm not a roof expert, but that concerned me. And so I brought it to the attention of somebody else in my group, and you know, they were like, hey Darin, you know, I'll do you a favor, call my roofer and ask him if he'll do you a favor and swing by. So I did, and he went by. He put a drone up in the air and took pictures of the roofs, and he came back and said, you know, yeah, I see what you're talking about, but there's just some minor repairs that need to be done. There's nothing, you know, they wouldn't have to be replaced, and I wouldn't be concerned about it. So that gave me comfort. Now, if I didn't have the relationship with the other sponsor, who didn't do me a favor by, you know, sending his roofer my way, I may have still been nervous about that. You know, now I have a relationship with a property management company. I could bring them out, or the contractor that did the rehab on my property. But the first time going about it, you know, it's hard to get those contractors to go out and look on your behalf without paying them, you know. So you do as much as you can is the answer, but it's never perfect until, you know, the time that I was comfortable was after I was already in contract. I already wired the hard money. I hired the inspection company. The inspection company came and did all the due diligence. And at the end of the day, I said, hey, Brian, do you see any huge red flags? You know, is there anything I should be concerned about? And he's like, no, I think the property is in good shape. So that was when I had a little comfort, you know. But at that point, if he had told me, yeah, man, there's some serious issues here, I don't know. You know, I'd have to look at whether it makes sense to lose that money or not. I mean, there's not a perfect answer to that.
Great. Thank you so much. Anybody else? I mean, what pretty much rounded out kind of the, you know, the numbers and kind of your business plan, the projections and anything like that. And we kind of answered a lot of questions in between. Anybody in the group have any kind of last parting questions, or, I mean, anything related or unrelated, love to help since we're all together. I think
Can you hear me?
Yes.
Yeah.
Hi. I just had one question about something that you mentioned, and that was with regards to the multifamily deals that you typically don't have a buyer's broker in the deal, or your agent, so to speak, in the deal. So
Right.
are you just relying on the seller's broker to prepare all of that paperwork? And I don't know, I feel like it's a little strange, because typically you would have your broker to make sure that, the paperwork is, I don't know, in your favor or something like that.
When you say paperwork, are you talking about the contract?
Yes.
So
Like when you make your offer.
So we did have an attorney review the contract, and we negotiated the contract. So we had our attorney and they had their attorney. But in terms of the offer, in our deal, we did have a buyer's broker that came from the multifamily mentorship group that we're a part of. But in many multifamily transactions, there is no buyer's broker, and in that case, the selling broker will provide you with a contract, okay, and then you'll present that to your attorney, and then your attorney will review it and come back with red lines. You'll also review the contract and come up with your possible negotiating points. So the contract is a negotiation, and you have an attorney to help you, but there's typically not another buyer's broker. We did have one because we're part of this multifamily mentorship group, but the typical scenario is that you wouldn't.
And even in that 2-week due diligence period, you're not allowed, or you can still lose your earnest money?
I'm having to take one earpiece out now. I'm hoping that the other one stays live. Hold on one second. This one's dying on me. Can you still hear me?
Yes.
Okay. So again, in a traditional market, you would have that 2 or 3 week due diligence period, and you would not have any money at risk. Okay. Or maybe you only put $1,000 at risk or $500 at risk. And then you would do your due diligence. But in today's market, if you put your letter of intent and you don't put hard money, you just will not win a deal. Okay, it's because the seller, they're going to receive 10 other offers where people are putting hard money down. So how did we get here? Right? I mean, people are like, okay, well, why did this ever happen? Right? Well, you had 10 people that were putting offers in, and at one point, somebody who had a lot of money wanted to win the deal, and they said, you know what? I want the deal so bad, I'll put $100,000 down. Hard day one. I don't care. And then that broker saw that, and then, the next deal, they say, hey, you want to win the deal? Put some hard money down, and now it's just commonplace, and you just won't win a deal without it. I can't speak for smaller deals, like 4 units or 8 units or 10 units. I don't know if it has that same competitive nature, but 60 unit and greater, I'm friends with sponsors all over the country, and I have not heard of a market that in the large multifamily space that doesn't have that day one.
Okay. Thank you.
You're welcome.
Francisco?
Yeah, I just had a quick question about I know you mentioned earlier you were part of a mentor group with Brad Sumrock. Actually, he's one of the ones I've actually been following. There's about 6 or 7 of them that I've been following.
Right.
They have different mentor programs throughout the country. I was going to ask you, first and foremost, how did you determine or like which one to go with, since there's quite a few options in the marketplace?
Right.
And secondly, what would you say? I know they all charge in the thousands, but some of them can range from 5,000. I've heard all the way up to 50,000. How would you determine like what you feel is a fair price to invest in one? And lastly, I was wondering, since I'm in Connecticut, should I look at maybe one of these programs where that individual is closer to my market and more familiar with my market, or that doesn't really matter because at the end of the day, a commercial investor is pretty, well versed as long as they've had experience?
Those are all very good questions. So for me, I went to a multifamily meetup group. I met a couple that was part of this multifamily mentorship group, and they spent 45 minutes with me, just talking me through their experience. And the group was based here in Dallas, so it made sense for me to join here. I ended up joining, and then I went and met with a bunch of syndicators, find out, is this real? And I would set up Starbucks meetings and ask them their experience, and one after the other was like, changed my life. And it was very different for me that how open that all these individuals were in terms of talking about their net worth.
Yes.
So they would be like, hey, my net worth was here and now it's 5 times, or my net worth was here and now it's 10 times.
Oh my
and
God.
Yeah, I mean, like crazy numbers, right? And so after meeting with enough of those people, I was like, okay, people are making money here. If they can do it, I can do it, type of thing.
Yeah.
And because it was based here, it was a no-brainer for me. Two things I'll hit on. One is, okay, does it make a difference in terms of geography where they are? I would say yes. So the brokers here in Dallas all know people from the Sumrock Group. Okay.
Gotcha.
So when I call a broker and I say, hey, I want to do a property tour on this 100-unit property, if I was not part of this mentorship group, the next question he would probably ask me is, what do you own? And I would tell him, I don't own anything other than my residential house. That broker immediately would put me at the back of the line. Like, he would, it doesn't matter if I've been successful in other business, unless I had $2 million sitting in the bank account that I could show him proof of funds for the down payment, he's most likely not going to take me serious. But once I say I'm part of this mentorship group, I've had a number of brokers that immediately have turned and I could tell the credibility just switched.
Yes.
It turned from, all right, I understand that you're new at this, but we've done a lot of deals with people in your group, and the first timers always seem to partner with experienced people, and we've never had a deal that didn't close because they couldn't raise the money. So a lot of the brokers in town have a ton of confidence doing deals, whether it's with Darin or with most people within the group. So you get credibility just for being part of that group.
Yeah.
So if you're wanting to buy in Connecticut, you can learn a lot from people in the Sumrock Group, but the brokers in Connecticut most likely aren't going to know that. You're not going to have the same reaction as a broker in Dallas. Now you can turn around and let them know, hey, I'm part of this mentorship group based in Dallas. This would be my first deal, but within the group, the group's done over 500 million in the first half of 2019. Maybe that gets them, but it's not the same as already already knowing and already working with people in the group. So people ask me, Darin, is there value in going into one of these mentorship groups? So you heard my background. I used to trade multifamily loans. I still have a company that trades multifamily, commercial, residential. I know the asset class. So with these mentorship groups, part of it is like education. Okay. Our group has like 18 webinars. Immediately when you join, you could review those webinars. And I watched all of them. So that's a piece of it. That piece wasn't as big to me because I knew a lot about multifamily. But what is huge is the ecosystem associated with it. So it's all the other syndicators that I met that have done 2, 3, 4, 5 deals. And I just have free access to all these people at these meetings to ask questions. What property management companies do you use? What attorneys do you use? What inspection companies do you use? How'd you raise the money? What software programs do you use? All those questions, like learning from other people that have done it, shrunk the time frame for me tremendously. If I had tried to do it on my own without having all those conversations, I think it would have probably taken me, probably double or more. So instead of taking 1 year to get my first deal, it probably would have taken me 2 or 3 years, So that's the value in it for me is the getting exposed to an inner circle of other people that have experience doing what you want to do, and then getting access to all the partners that you need to make your deal successful. Attorneys, inspection people, property management companies, relationships with brokers, finance companies, etc. So I've met some great syndicators outside of the Brad Sumrock group too. There's great groups all across the country. I mean, there's the Rod Khleif group, there's Jake and Gino, there's Joe Fairless. There's another group in Dallas called Think Multifamily. Michael Blank has a group. What's that?
Do any of them come to mind on the East Coast, or even Dwaine? Do you know of any that might come around that come to mind here in Connecticut, since you might be a little familiar with this market?
Yeah, they don't have any events up here, but like Jake and Gino, I think, is in Tennessee. But like Rod Khleif, all those guys, they're in all these multiple states: Orlando, Colorado, New Jersey. Just find out where the closest one is. They're running them, and they're pretty much the same thing. And then they offer the mentorship groups in there that offer tons of value. So it really doesn't matter which market, as Darin was saying, they can be able to kind of help you. Of course, the bigger advantage is if their expertise or their sources are local. That's definitely going to 10x everything. But any of these groups, they have boot camps and training stuff, and a lot of stuff now, like the stuff we're doing now, is virtual. You get the webinars, you get the one-on-one coaching, you get access to call them and everything. So that's kind of like the huge benefit, is whichever is your preferences, because all of them are doing big deals and nationwide. So it's good to hook up with any of them, but I guess it comes down to preference and budget and different types of stuff as well.
Gotcha.
Yeah, and then conference-wise, I'm trying to think of the closest conference to you guys. Like, there's been a few conferences in Boston and that have focused in on multifamily. I can't think of one in the last year and a half that has been in New York. But there's been 2 or 3 events in Boston that I can think of. And if you could just go to one of these events, you're going to meet a lot of syndicators, that have a presence in that market. And, as a follow-up, if anybody on the line, is looking for somebody someplace, feel free to private message me on Instagram, and I'll look through my database and see, who I know in that New England market that might be able to reach out to.
Thank you.
Yeah, we'll make sure to send out your profile link to the group so everyone can, add you as a friend and message you and see if there's any connections out here in the Northeast. So.
Right.
All right, friends and family, is any parting last thing? Darin, I really appreciate your time. I know it's a little bit later and, it's like, 8 o'clock your time there in Texas. So
yeah, 10 of 8.
So yeah, I really appreciate it. Again, I think I got one more in. Chris got a question.
Okay.
So I'm 20 years old, and
good for you. I wish that I had started getting into this stuff when I was 20 years old.
Yeah, you said
good
that.
For you. Yeah, good for you.
Well, yeah. So I do not have a lot of money,
right,
or anything like that. But I'm very interested in everything, and I'm willing to learn. So what can I do now to get started? And so besides attending groups and stuff like that, and another question, what is the best way to get deals without being taken advantage of because of my age?
Well, it's the same answer for two of your questions. You're not going to win these deals, and you're not going to be able to raise money as a 20-year-old who's never done it. Okay. When I say you're not going to be able to, I mean, I'm sure there's a 20-year-old out there somewhere that's figured out how to do it, but it's extremely low probability. You with no money, okay, and no deals under your belt, that you're going to win deals and raise money from other people. But what you can do is you have to find a partner that has experience. Okay. And so you have to work a little harder. Okay. And you do have to go to these multifamily meetup groups wherever you can find them. Yeah. And you have to meet sponsors. And at the meetup group, these sponsors are going to be talking to a bunch of different people. And what's your name?
My name is Christopher Castillo.
Christopher. So the sponsor is going to be like, nice to meet you, Christopher. He's talking to you 5 minutes, and then he's going to have somebody else trying to talk to you, right? Yeah. So he's not going to be able to spend a ton of time with you. But, make sure you exchange business cards with that person, and then ask if he'd be willing to get together with you for coffee during the week, okay? Yeah. And let him know that you're, potentially interested in passively investing at some point. Maybe you're not interested in passively investing now because you don't have the money, but at some point, that's a little bit of a carrot for him to want to get to meet you and spend time with you. And you may even say, other people that are interested in passively investing, so then when you meet with him, you need to develop a relationship where he's going to want to do business with you. So you have to have that skill, okay, that gets somebody that's older, more experienced, has more money, knows what they're doing, that is like, Christopher's a go-getter. You know what? I see a little bit of Christopher in me when I was 20 years old. You know what? I'd like to help this guy. You know what? I think Christopher can make me money, because that's what it comes down to, is that guy needs to walk away thinking, you know what? If he doesn't do business with you, that somebody else is going to do business with you, and you're going to make them money. Yeah. Right. So think about your network. Okay. Where can you raise money from? Is it your dad? Is it, your friend, your uncle, that network? Did you grow up near, in a country club and you have a lot of friends and family through the country club? Do you work at a company that has a lot of people that have money? You have to think about how can you tap into a network that has money, and you have to get over the limiting belief that those people won't take you seriously. Okay? You have to get to the point where you think to yourself, you know what? They're thinking of me as being little junior Christopher, but you know, if I get a chance to talk to them, I'm going to tell them how my partner, right? He's got some gray hair. He's owned a lot of multifamily. You know, he's returned a lot of great returns to his investors. And you got to sell the partnership and the returns and the opportunity to those people, you know? And then once you have that, where you have a partner who's experienced and you have a network of people that you think you could raise some money from, then you have a story to tell a broker, you know? If you call a broker right now, you're going to ruin your credibility because you don't have a story to tell.
Okay.
You're not part of a mentorship group. You've never done a deal. You don't have any money. You're not partnered with anybody. You know, you got to look at your strengths and your weaknesses and try to compensate for that. And you could do that by partnering with somebody. Just develop it. I think that's the way to do it.
Thank you so much. I really appreciate it.
Absolutely, and I believe you could do it, man. And I look forward to that younger generation, you know, knocking down some big deals. There's a guy that I know here in Dallas who's 25, 26 years old, and he is just a go-getter. Okay, he dresses like to the nines, like is always like in a nice sport coat or a suit, always presents himself very well. He goes to all the meetups. He networks. Everybody's like, holy cow, who is this guy? He's everywhere. And he ended up partnering. You know, he got some guys that believed in him, and he partnered with a few guys, and now he's got like 250 units as a general partner. He helped raise money for these other deals, but now he's considered an experienced general partner, you know, and it was because he developed relationships.
Okay. That's very interesting. Wow.
Thank you so much. Yeah, absolutely. So, yeah, like I said, just kind of piggybacking off of that is adding value. You know, you find a way you can add value. I see a lot of people now, they're like a first line underwriter. So they help, you know, because I know a lot of these, you know, sponsors and syndicators, they're looking at tons of deals, and, you know, they can use some extra legwork if you start learning how to use spreadsheets and running numbers, and you get really good at it. Maybe you can able to help and participate in analyzing deal, or get on the call and call owners, or help raise money and access that, and just bring some value to the table there. So
yeah,
great question. So so again, Darin, thank you so much. If you guys have any additional questions, just reach out to them on Instagram, or shoot me the question. I'll send it over, and we'll have a dialogue back and forth. If it's like you know, something you can shoot over in an email, and I'll make sure to have it in our next email blast out of the meetup group. But Darin, I'm very appreciative for you to take the time out of your day to go over this stuff, answer our questions. It's been extremely helpful, and really honored to have you again.
Absolutely. Thanks for having me on. And you know, this real estate world is really a cool network, because everybody is just trying to help the next guy, which is you don't find that in every industry. So I think that you know, for those people that are trying to do it for their first time, just know that it's in a lot of real estate people's, you know, psyche that to help the next guys. Don't be afraid to ask. You know, other people, they want to help the next person, and some people want to get, you know, have new partners. So don't be shy, and don't think that you have to do it without the experience of others. People want you to approach them.
Beautiful. Well, guys, again, thank you for joining us. Just look out for the upcoming emails. We have our first annual Christmas party for our meetup group, December 6th on a Friday at Jamaican Kitchen in Vernon. And then we have some other upcoming virtual meetups on self-storage and Airbnb. Just kind of learn some more stuff about that. But again, thank you, Darin, so much again. And we'll definitely be staying in touch. And again, great luck to you in the finishing off the year in 2020.
I appreciate that. You as well.
All right. Take care, guys. Thank you so much.
Take care, everybody. Thank you.
Bye-bye.